Hi, we are Group 9 and we are going to present you our assignment for the course of Advanced Finance. So we choose the rental and leasing services industry, and we took the monthly historical prices of 10 stock from June 2007 until August 2013. First, we are going to talk about the data analysis, then about the efficient frontier, and finally, we are going to test if the CAPM holds. So let's begin. Here we can see that the stock URL, so here, has the highest return and the second lowest variance, here. It has a low volatility and thus a low risk. In our case, this is the stock URI, which has the highest volatility, here. In this slide, we are going to present you the excess return of our 10 stocks and the equally weighted portfolio. The excess return is the difference between the return of an asset and the return of the risk-free asset. We can see that 6 of the excess returns are positive and 4 are negative. And the negative is this one, this one, this one, and this one. It means that 4 of the stocks have a lower return compared to the risk-free asset during the studied period. Here we observe that the return of our industrial portfolio, so here, is negative. However, its variance is low. Now I hand over to Delphine.
So, the graph shows the excess return of SC and AER. We'll try to explain a little bit the fluctuations of the returns over time. We can see that for the first one, this one, which is an independent aircraft leasing company, there is a pretty high volatility. We could say that because an aircraft leasing company have only a few big customers, the customers have a big influence on the company profitability and thus on its market share. The tendency for the second graph, so AER, is different. The company, which is also an aircraft leasing company, was probably hit by the crisis in 2008. For the rest of the period studied, there is no particular fluctuation. The share price of the industrial portfolio is less volatile over time due to the diversification in the investment. So we can see that here.
Now, after having constructed the efficient frontier, when focusing on the risky assets only, we compute the GMV portfolio. Here we can see its return, its variance, and its standard deviation. After that, we would like to illustrate the principle of diversification. Our purpose is to demonstrate that we could reach the same return as one of the stocks, but having a lower risk. At first time, we look, for example, for the stocks which has the biggest return. In this case, it's the UL stock. Then we look for the efficient portfolio which has the same return. Here we can see that the portfolio has for the same return a lower risk. This graph can illustrate what I said. On the y-axis, the efficient portfolio and the UL stock are on the same level and has thus the same return. But on the x-axis, the efficient portfolio has a lower standard deviation, or in other words, a lower risk. In this slide, we introduce the risk-free asset, which induces the apparition of the capital market line. There are two graphs, because on the first one, we cannot see the tangency portfolio. Indeed, its return and its variance are very high. The intersection point between the efficient frontier and the CML gives us the tangency portfolio. This portfolio is relatively risky, but gives also an important return comparatively to the GMV. On this slide, we have the value of its return, its variance, and its standard deviation. Here we can see that the frontier of the industrial portfolio, this is the black one here, is below the two other lines. It means that the rental and leasing services industry has a return lower than the market average and the SP 500. We see that the slope of the black line here, the slope of the industrial portfolio is negative. So we don't invest in this one because we could expect a higher return on the global market.
So I'm going to talk to answer the fourth question, which talks about the validation test of the capital asset pricing model. When we analyze the following results, we can see that the beta of the industrial portfolio is significant because the p-value of each asset is inferior to 0.05, while the beta of the SP500 aren't significant because one of the assets named NTGL has a p-value that is superior than 0.05. So that means that in the industrial portfolio, we can reject the null hypothesis and say that the beta are different of 0. In contrast, considering the SP500, we cannot reject the null hypothesis. More, we know that at most R square is close of 1, at most the model is efficient. So considering this, we can notice that the R square of the industrial portfolio fluctuates between 0.1 and 0.477. So we can say that it is quite good, sorry. While in the SP500, it fluctuates between 0.03 and 0.516. The scope is bigger and some of the R square are too small. So in conclusion, we can say that the CAPM test holds with the industrial portfolio. So our presentation is finished. We found this work quite difficult, but really interesting because we learned how to use the R code. I hope that you enjoyed our presentation, and we wish you a Merry Christmas and a Happy New Year. Thank you very much. Bye. Man, it doesn't show signs of stopping, and I've brought me some corn for popping. The lights are turned way down low. Let it snow, let it snow.